Welcome back to Freedom Ain't Free. How would you like to own a piece of the entire world? In today's video, we're going to be discussing how mutual funds work and what type of mutual funds should you invest in. My name is Joel Huey. I am the principal of ARC Financial Strategies, and this is the Freedom Ain't Free channel. Here on the Freedom Ain't Free channel, we're going to walk you through how every financial instrument works. Our goal is to help you to put together a portfolio of $2 million so that you can buy back your life, so you can access the rat race. With $2 million in your investable portfolio, we should be able to get somewhere between $120,000 and $160,000 a year in income, and that will make you financially free here in America. Our objectives here at the Freedom Ain't Free channel is to get you the wisdom, the knowledge, and the understanding that you need to utilize all the tools to get you there. We are going to talk about each and every strategy that is currently available. At ARC Financial Strategies, we primarily work with a group of people we refer to as Henrys. Those are high earners, not rich yet. You figured out how to make some money. You figured out how to earn some income. What we want to show you is how to turn that income into investable assets and then turn those investable assets into income that you no longer have to work for. So you can go spend time with your family, so that you can pursue the passions that you have, and so that you can live the life that God intended for you to live. So if you want to connect with us and get your freedom number, that's how much money you need to save on a monthly basis for you to build that $2 million portfolio and get completely free. There's going to be a link in the video below where you can schedule a free consultation and get your freedom number. Now let's spend some time today talking about mutual funds. So here at the channel, we're going to go through each and every instrument or vehicle or option that you have to build the portfolio to buy yourself some freedom. So today we're going to talk about mutual funds. Mutual fund is an investment vehicle where many investors pool their money together to buy a professionally managed portfolio. Now that portfolio may invest in stocks, may invest in bonds, it may invest in money market instruments. You are pooling your money together with a group of other investors. You're hiring a professional money manager to take those dollars and go out, invest those dollars on your behalf in stocks and bonds and money market instruments, create a profit, and then give you back your part of that profit. That is the core understanding of a mutual fund. The pooling creates instant diversification. Your money is spread around a various number of different entities or companies. As an example, you might have a S&P 500 index mutual fund. That means that company is investing into up to the 500 companies that make up the S&P 500, right? So you have a fractional share or a little bit of each and every one of those companies. Therefore, if any one company goes out of business or if any one company struggles, another company may be having a successful year, and they pool the profits and the losses together, and that creates a value within the fund. Mutual funds are bought and sold based on their net asset value, and net asset value is the assets of the fund minus the liabilities of the fund. And then it's divided then by the number of outstanding shares. So however many people have invested in the fund is the number of outstanding shares, and that's how you come up with the net asset value. Mutual funds are traded once a day. We'll talk a little bit more about that in just a few minutes, right? So here's how mutual funds work. I'm going to give you the 5 components of a mutual fund, and from this day forward, you'll fully understand how a fund works. So number 1 is pooling money, right? So individual investors contribute money to the fund, right? So 10 people, 20 people, 100 people, 1,000 people, 10,000 people have invested money into the fund. So it's a pool of money spread around a bunch of individual investors. They then hire a professional money manager, right? A fund manager or a team decides which securities to buy, when to sell them, when to hold them, right? So the money management team is actually making the investment buys and sales. They're the ones that are studying those companies. They're the ones that are studying the market. They're making a decision on when it's the right time to buy and when it's the right time to sell. So what I generally want you to understand about investing is there's trading and then there's investing. Trading is when I buy a stock at this amount and I sell it when it gets to that amount. That's trading. Investing is when I buy a share within a business that I intend to hold on to that share because that company earns a profit. When that company earns a profit, they pay a dividend back to their shareholders. So I'm making an investment because I'm looking for a dividend, that type of dividend income, to come back to me based upon the performance of the company that I own. That's investing. What professional money managers do is a combination of trading and investing. Some stocks they're buying just to buy low and sell high. Some stocks they're buying to hold on to for the long term and to get that dividend income to come into the fund. The next piece of the puzzle is diversification, number 3. So we have a pool of money spread around a bunch of different securities. Therefore, no one security can make or break the fund. You could have securities purchases in stocks. You could have securities purchases in bonds. You can have securities purchases in money markets. The money manager decides what they want to invest in, how long they want to invest in, and they tell you how many companies that they're going to spread your money around. So you invested $100. They took your $100 and they spread it around, say, 100 different companies, right? So you got $1 in each company. So if one company is having a great year and another company's having a bad year, you have an average, and that becomes a part of the value calculation of the fund. But you have diversification spread around a lot of different industries. So when I say, how do you own a piece of the entire world? Well, a mutual fund may be investing in companies from all around the world. So here you have an opportunity to be living here in America and owning a piece of companies from all around the world. You can own a piece of the entire world. Number 4 in how mutual fund works is the net asset value calculation. So the fund's value is calculated once a day after the market closes based upon the portfolio's performance of that individual day. So some days are better than others. So the value of the fund goes up, the value of the fund goes down. So you can buy shares of the fund every single solitary day. You can sell your shares of the fund every single solitary day, but those things only happen once a day. You make a purchase once a day, you make a sale once a day. It doesn't happen every minute or every hour throughout the day like an individual stock or an individual bond would or an ETF, right? And we're going to talk about all of those different tools and pieces of the puzzle here on the Freedom Ain't Free channel. So make sure you stay connected. Next week's video is going to be amazing. We're going to be digging in to my favorite investment strategy called direct indexing, right? We're going to talk about that next week. But the 5th component of your mutual fund is the share value, right? Investors buy shares in the fund daily at net asset value, right? So that's the share value. It's calculated once a day, and then you have the share value. So you're buying or you're selling based upon the share value. So those are the 5 components that make up a mutual fund. Now let's talk about the benefits of mutual fund investing, right? There are basically 4 benefits to mutual fund investing. We'll wrap up today's video, and I'm going to share with you guys in the comments a link to a very special book that I want you to get, that I want you to read that's going to help you, right? So the key benefits of mutual fund investing, number 1, we talked about already, diversification. You don't have all of your eggs in any one basket. You have your investing spread around multiple companies. Therefore, no one company can make or break your overall strategy. Number 2 benefit is professional management, right? You don't know when to buy. You don't know when to sell. You don't know what to buy. You don't know what to sell. You're not studying the market all day long, every day, to know where the values are, where the strategies are, where the opportunities are, and what things we need to get rid of. So you hire a professional money manager to do that for you. Number 3 benefit of a mutual fund is affordability, right? You have the ability to buy fractional shares into companies because you're buying units in the fund. The fund is buying full shares. You're buying units in the fund, right? So the fund owns 10,000 shares of Apple, right? And you own a fraction of a share in the fund, right? So you could not afford to go out and buy 10,000 shares of Apple as an example, but you can afford the $100 to buy a fractional share in the fund. So affordability. This allows every single solitary person access to a piece of the world, right? So when you're sitting there thinking that you can't afford to invest, I want you to understand that yes, you can. You can afford to invest and grow your portfolio and buy your way to financial freedom. And then the number four benefit of mutual fund investing is convenience. It's an easy way to buy and sell your investments. It's an easy way to grow your portfolio because you don't have the responsibility of making a decision of what to do, when to do, how much to do, right? You can get in and you can go back to doing the thing that you're doing to earn the income that you're earning. So I figured out how to make $80,000 a year. I figured out how to make $100,000 a year. I figured out how to make $250,000 a year. I've used the ARC strategies to get myself out of debt. And now that money that I was spending, pouring into my mortgage, pouring into my car payments, pouring into my credit cards, I can take that same dollar amount, put that money into a mutual fund strategy, and now I'm creating wealth off the dollar that used to simply pay my debt. It's a convenient way to get into investing, convenient way to buy and sell. So recapping real quick. Mutual fund investing, once again, is an investment vehicle where many investors are pooling their money together to buy a professionally managed portfolio of various securities. That's what a mutual fund is. Now, most of you are doing your mutual fund investing through your qualified plan through your job. So you have a 401k, you have an IRA, you have 401k, a 403b, a TSP, a 401a. Those strategies through your employer are referred to as qualified plans. Inside of your qualified plan, you have various mutual funds that you can invest your money in. You put in $1, your company matched that dollar, and then those $2 went and purchased mutual funds, right? So what I want you to do is pull out your statement from your company. What you're going to find on there is it's going to give you what is referred to as your rate of return, right? So we want to talk about the types of mutual funds for you to invest in. When you look at your portfolio, when you look at your statement, it's going to tell you what your rate of return is. All you need to know about mutual fund investing is how long is it going to take for my money to double if I invest in this mutual fund. And in order for you to calculate that, you simply need to know the rule of 72. The rule of 72. Here's how that works. You're going to take 72, put that in your calculator, divide that by whatever your report says your rate of return is, right? So let's say the report says that you got a 1% rate of return. 72 divided by 1 says it's going to take 72 years for your money to double, right? Say you were getting a 10% return on your money. 72 divided that by 10 says it's going to take 7.2 years for your money to double. Let's say you're getting a 20% return on your money. 72 divided that by 20% says that it's going to take 3.6 years for your money to double. So let's say you had $100,000 in your 401k. You're getting a 20% return on your investment. 3.6 years from now, your $100,000 is going to be $200,000. You want to pull the list of your mutual funds. You want to look at all of the options that you have. You want to take the rule of 72 to determine which of these strategies is going to help my money grow the fastest based upon my risk tolerance, right? And then once you're able to do that, you can evaluate which fund is the best fund for you to accomplish what you want to accomplish based upon the risk that you're willing to accept. And then lastly, the fees that are involved in that individual strategy, right? I tell all of my clients, I'm willing to pay a little bit more for better performance, right? So you want to look at the cost for that strategy. Is it performing better than the market? And I'll pay a little bit more if it's performing better than the market. So once you figured out which fund you want, you put your money in your strategy into that fund, and then you let your money grow. The money managers are going to do their job, and they're going to help your money grow. So depending on your risk tolerance, depending on your age, your income bracket, and how long you have to invest, those are the methodologies you're going to use to pick your funds, right? You'll see mutual funds fall into categories like target date funds, right? Where they're going to say, I'm 40 years old, you're going to retire at age 65, so you would buy the target date fund for people who are retiring 25 years from today, as an example. You're going to find growth and income funds. You're going to find growth funds. You're going to find aggressive growth funds. You're going to find international funds. You're going to find bond funds. You're going to find money market funds, right? These are the various different types of funds that's going to show up in your offering. They're going to give you their 1-year performance, their 3-year performance, their 5-year performance, their 10-year performance, and then what's referred to as since inception, right? So that's how long has this fund been in existence? How long has this fund been around? Okay, and this is the performance that it's had since it's been in existence. Take that number, plug it into the Rule of 72 formula, and that's going to help you determine if that fund's going to meet your goals and your objectives. One of the things I share with my clients is we do at ARC for our fee-based clients is a free 401k review. Let's look at the performance of that part of your portfolio and make sure it's in line with your overall portfolio. The advantage behind that is understanding how all of the components come together and whether I'm taking on too much risk or I'm not taking on enough risk within this vehicle, and maybe I'll turn that risk meter up and move myself up to the next level. So those are all of the strategies that are available. I figure out which fund I want, and then every quarter you're going to get a statement where you can monitor your results and then make a decision on whether or not you want to continue with that strategy or move to another mutual fund strategy. So we wanted to take an opportunity today to help you to understand mutual funds and how it fits in your overall portfolio. Here at the Freedom Ain't Free channel, we're going to take you through every vehicle that's available, and we're going to show you how to utilize every vehicle in your overall portfolio to get you to financial freedom. We don't believe that there's any one vehicle that's going to do everything you need it to do. We believe you need to have multiple vehicles to get you where you want to go, if not every option available to you to create the freedom that you're looking for so that you can go out and be passionate about the things you're passionate about. You can spend time with your family. You can go and visit family that you haven't seen in a very long time and stay as long as you like once you get financially free. We want to break you out of the rat race. We want to break you away from that business that you've been working on and building on for 15, 20, or 30 years and give you back the life that you so richly deserve. My name is Joel Huey. I'm the principal here at ARC Financial Strategies. Thank you for joining me for this Freedom Ain't Free episode. We look forward to seeing you next time where we're going to talk about direct indexing and how to own fractional shares in every single solitary strategy and every single solitary company in the S&P 500 index that you own, and you can manipulate and get the growth that you want. So excited about that. Look forward to seeing you guys next week. Don't forget to subscribe. Help us spread this all around this great nation. And if you want to schedule a one-on-one consultation with us, the link will be down in the description. Jump on and we'll make sure that we get you your freedom number. Thank you for joining us today. Peace.